That's Shikha Sharma.
Being here for our quarterly results. Before we go into the actual numbers of the quarter, I'd like to just touch on three broad themes. The first is emerging trends in the macro environment. Two is progress on the asset quality cycle and the resolution cycle. And three is last quarter we had talked about an execution strategy for this year, and I'd like to just talk about progress against that strategy. So first, the macro. Despite a build-up in global uncertainty, we are certainly seeing growth momentum seem to be picking up in India. In line with consensus, we expect a growth of 7.5% in FY19, which will be significantly up from 6.7% last year. Even as consumption demand remains strong, we are finding investment activity come back and improve gradually. Hence, the growth drivers are now getting more broad-based. This is evident in a recovery in industrial activity with an average growth of 6.6% in November 17 to April 18 compared to 2.4% in the April to October numbers. CV sales, passenger vehicle sales, two-wheelers, tractor sales, all of them are pointing to a recovery and sustained demand, especially in the rural segments. Domestic bank credit, which had been very tepid, has improved from 8% in FY17 to 12%. Large corporates are certainly beginning to talk about finalizing capex plans, and we are optimistic that a growth of 12 to 13% on loan growth in corporate should continue. But we also expect retail and services credit demand to remain strong. Foreign investors remain confident on India's prospects, with net FDI flows in FY18 at $31 billion and continuing flows in April and May. However, despite expanding domestic opportunities, we remain mindful of evolving global and domestic risks. We live in an uncertain world fundamentally. Shrinkage in domestic liquidity has certainly led to an increase in cost of funds, and you've seen an increase in, consequently, lending rates of banks. This trajectory might continue for some more time if we continue to live with the current market situation. There's also been a sharp uptick in fixed income yields, especially on GSEC rates, which have moved more than 100 basis points during the past year. And you've seen that already in some of the results, that has meant noticeable MTM losses for banks. Fortunately, we had a fairly conservative posture here, and we have seen MTM impact, but it's not significant, and we have provided for it entirely in this quarter, not utilizing the special dispensation offered by RBI. Moving on to asset quality, as we saw in the financial stability report released by RBI, GNPA ratios in the banking system have increased sharply in the last 2 years and ended March at 11.6%. We have equally seen an increase in our GNPA ratios. However, the good news is that the significant acceleration of NPAs, which was driven by the last February 12 circular, now seems to have noticeably slowed. And we see sectors of stress remain largely the same as before, but the volume of stress is certainly coming down. We haven't seen new areas of stress emerge during the quarter. As the slippage cycle abates, we are also seeing gradually the recovery of, the beginning of the recovery and resolution cycle. And I think the NCLT framework and the IBC framework have had a material impact as far as resolution recovery is concerned. Certainly, some cases are getting dragged on, and there's a disappointment of some decisions taking time. But I think net-net, the IBC process has certainly had a material impact as far as resolution and recovery is concerned, both within the NCLT and outside the NCLT process. Our experience this quarter, and you'll hear more about it from Jairam, certainly seems to suggest that the asset quality has turned. As you've been hearing it for a long time, but this quarter's numbers do support that. Last of all, the execution strategy. Last quarter, we had introduced an execution strategy for the bank this year, especially given that there's a CEO transition in place. We wanted to highlight that. And in that, we had mentioned some of the key pillars of what Axis would be focused on this year. I'm happy to report that we've certainly made progress against all of those pillars. Our first vector was to normalize credit risk. And for those of you who've seen our result numbers, you'll see that we have certainly made significant progress in the direction of normalizing credit risk. New NPA formation has moderated significantly, and we are beginning to see the benefits of the recovery cycle come in. As a result, we feel positive as far as progress on normalization of the risk environment in the second half of this year is concerned, which is what we had said we hope to achieve. That, while the first half we will still see a migration, second half we hope to get to normalization of credit numbers. The second vector we had talked about was delivering profitable growth, and with liquidity environment having changed and therefore a shift in demand from bond markets to bank credit, we are seeing bank credit grow, and we are seeing the signs of that in our lending growth numbers as well. And we're hoping that this is going to start translating into pricing power as we go along. Provisions have declined and cost efficiencies have improved as well, so all of that adds up to getting profitable growth. We had laid out that in the long term we want to get to a cost to assets ratio of 2% over a 2 to 3 year period. This quarter you will see that our cost to assets ratio has come down, and we hope to remain in that direction through the rest of the year and going forwards. Capital efficiency has also improved, as we've been saying for the longest time that for the last couple of years we have been focused on originating better quality assets in the corporate book, and therefore as we see NPAs normalize and recovery come back and the benefit of the new originations come through, we expect to see a very different balance sheet, and that's reflecting right away in terms of our capital efficiency ratios, because the better composition of the corporate book means that we have lower risk weighted to book number. The third vector we talked about was operational risk and the need to focus on that in an environment which is much more focused on operational risk, and we continue to make investments there both in terms of people, technology and process improvements to make sure that you can't do away with it, but how do we minimize incidence of operational risk going forward. The fourth and last vector we had talked about was continuing to invest in the future, and when we talk about continuing to invest in the future, the big disruption that one can expect is really around digital and technology and how that's going to come and disrupt this market. And we're really happy with some of the progress that we have there, whether it's card spends, whether it's mobile spends. We continue to have a very significant and leading position in both of those. Our credit card growth numbers are amongst the highest in the industry. Our mobile spend numbers continue to be amongst the highest in the industry. We also have a leadership position in UPI. So as I said, we're happy with the investments we've made on all of those, Axis Mobile, Axis ASAP, Axis AHA, and we think that having free charge as part of the franchise just gives us a whole lot of interesting digital properties which should insulate us from disruption in the future. We are focusing on digital lending as well. For some products, it's more amenable rather than the more complex products. And personal loans, for instance, this quarter we originated 30% of personal loans digitally, and I think that number should continue to increase in the future. So I think we feel good about the progress we've made on the strategy, and I believe that Axis is pretty well positioned to stay on that path of transformation. So with those remarks, I'm going to hand it over to Jairam to walk you through the numbers, and I'll be happy to, both I and the team will be happy to take questions as we go along.
Thank you, Shikha. There are 3 or 4 areas that I'd like to touch on. You have some of the numbers hopefully with you. Firstly, from a P&L perspective, we ended the quarter with a profit after tax of 701 crores compared to a loss that we had in Q4. So clearly returned to the black for the bank. From a core operating profit perspective, core operating profit was up 23%. So if you look at operating profit X of trading, which tends to be quite volatile, the core operating profits were up very strongly, 23% YOY, 24% QOQ. The NII was the big story in this quarter. Net interest income came in quite strongly, 12% growth YOY, and a net interest margin which increased from last quarter's level of 333 and ended this quarter at 346. So we feel very good about the NII bump up that happened. The OPEX continues to moderate, to Shikha's point earlier on cost to assets. We continue to come down on the cost to asset curve, and we reduced cost to assets by 1 basis point in this quarter. The provisions, while up on a YOY basis, are of course down quite significantly on a QOQ basis, we made provisions of 3,338 crores in all and increased our provision coverage ratio to 69%. There was an MTM loss that the bank took of 135 crores in this quarter because of the rate movements. We have recognized all of that in this quarter and have not used the RBI dispensation on this. On asset quality and NPAs, both the gross and the net NPA ratio of the bank have fallen. Gross has fallen to 6.52 from 6.77, and net has fallen to 3.09 from 3.4. So fairly substantial movements on both those ratios. Slippages themselves have come down quite materially as well to 4,330 odd crores. Provision coverage, as I mentioned before, has been increased to 69% now. And we continue to see an environment in which most of the slippages in corporate credit continue to come from our previously disclosed BB and below book. In this quarter, that proportion was 88%. We have seen over the last many quarters an elevated level of downgrades from the BBB book down to the BB and below book, and we've been talking about it every quarter. After this quarter's downgrades that got completed, we believe that elevated level is now done, and we are back to more normalized levels of slippage from rating slippage from BBB to BB. So that BB and below pool should now not see much increase from these levels because of downgrades. Loan growth was 14% YOY, mostly driven by retail and SME, which grew 21% and 19% respectively. Corporate continues to be in single-digit growth. Our loan-to-deposit ratio at the end of this quarter was 99%. Shikha spoke a little bit about the digital space. We're making lots of good progress there on the CASA side as well. On retail, we continue to do well. On a daily average basis, CASA grew 15%, and within that, you saw CAR grow 8% and savings accounts grow 18%. So on a daily average basis, we continue to have a really strong build-up of deposits. Finally, contrary to what tends to happen in the first quarter, where you tend to see a little bit of capital consumption because you have growth to fund and you've got operational risk, RWA to fund. In this quarter, we actually saw accretion of capital. So our common equity tier 1 has increased now by 18 basis points from the position we were in the last quarter, and we now stand at 11.86% compared to the 11.68 we were at the end of last quarter. So overall, a quarter in which we had momentum turn as far as core operating metrics are concerned, reasonable growth on the balance sheet front, balanced growth between both advances and deposits. Both of them came in at 14% growth. We also saw improvement in core things like net interest margin, which are a lot more sustainable. We saw significant recoveries and upgrades, both from the NCLT process and also from outside the NCLT process. And we had improved capital efficiency and capital ratios. So overall, a satisfactory quarter, a quarter which is in line with what we thought we were on track for during the course of this quarter, and hopefully we will continue to repeat over the coming quarters. Thank you very much for listening.
Question, with respect to the asset quality review, we understand that the Reserve Bank of India is conducting a second round now. While the PCR has improved substantially to 69%, could you give us a sense of how many accounts have been discussed and what is the kind of hit that the bank will have to take or increase the provision coverage to what extent to meet RBI's requirements?
See, there are some headlines we've seen floating on the channels today. There is nothing we have seen that'll aid us in confirming, what I've seen kind of passing on the tickers. All of us are going through in a staggered manner our annual review with RBI, and that will conclude over the course of the next few months for us, and then we will see what happens. But to say that there is a new asset quality review, I think it's a little bit of an overreach. We haven't heard anything of that nature.
So just to follow up on that question, as per the RBI Federal Circular, August 27 is the new deadline, and we are looking at possibly new accounts to be identified. So will that put further pressure on the bank, and will you have to increase provisioning for the accounts that will probably be identified, or the bank have already identified some of the accounts?
I think the February circular is very clear in terms of accounts where banking system exposure about 200 crores. If it's not resolved by August 27th, it goes into NCLT. I think that process will flow through, and I don't think so anything which happens after that is going to disturb that. So clearly I think the February circular stands, and that's what will happen. Of course there's talk in terms of power sector and what happens to that, but that's an independent discussion. As of now the February circular stands, and anything which is mandated as per the February circular, it will happen.
And as far as provisions are concerned, because on all our NPAs we are already provided at 69%, we find it unlikely that even if the accounts move into an NCLT process, we find it unlikely that there will be any significant further drain on NPA provisions.
There's also talk about some of the power assets now being either sent to NCLT or finding buyers before that deadline expires. Could you give us a little more sense of what is your exposure to some of these power assets? What is the recovery you're anticipating from them?
Yeah, as far as exposures are concerned, we have a slide in our earnings presentation this time around where we've specifically talked about the power sector. So you should take a look at that. Power sector total exposure has been very steady compared to last quarter. It has actually fallen quite a bit. We are now at about 17,000 crores. 42% of our power exposure is already deemed NPA. 43% or so is deemed NPA. And you might recall that there have been some disclosures made by the ministry as well as the power ministry as well as some of the large finance companies in the public sector around stressed power sectors, stressed power projects. We have evaluated all those lists very closely, and we feel very good about our exposure in light of those disclosures. All the stressed power sectors are by and large NPA with us already. So